We are here today to compare the foreign currency exchange exposure of a US based multinational corporation, Ford Motor Company, and an American depository receipt, Toyota Motor Company. Through this analysis, we will observe how foreign exchange rate fluctuation affect companies with different home currencies. We will also compare how automotive companies can successfully hedge against this risk. Starting with Toyota. Toyota has been traded on the New York Stock Exchange as an ADR sponsored by the Bank of New York Mellon since 1999. The firm's home exchange is in Tokyo, but Toyota is also traded on the London Stock Exchange. Toyota has grown into the sixth largest company in the world in terms of revenue since beginning in 1933. Toyota operates predominantly as an automobile manufacturer, but the firm also produces industrial goods and has a commercial financial segment. For the fiscal year 2018, Toyota operated through 606 consolidated subsidiaries and 199 affiliated companies and operated in every region across the world. Toyota deals with many different functional currencies, which exposes them to a great deal of currency exchange fluctuation risk. Moving on to their methods. Toyota's operating income and other financials are broken up into the following regions: North America, Europe, Asia, and other. To cope with this, we developed indexes of currency returns based on Toyota's major market in each region. Each foreign currency was weighted based on relative size of national GDP. GDP was chosen to serve as a stand-in for consumer buying power. However, for North America, Toyota reported that the United States accounted for 87% of revenues for this region. Therefore, US dollars was weighted by 87% and the remaining 13% was split between the Canadian dollar and Mexican peso based on relative GDP.
Our short-long positions were developed based on the regional operating income of Toyota. This breakdown can be found in the company's 20F as well as on Bloomberg. Japan is the company's most profitable market. It is the number one producer of Toyota vehicles, and the company controls 46.9% of the nation's automobile market share. This provides Toyota with 1,659.9 billion in yen in operating income. This gives the company a long position. A strengthening yen is bad for Toyota, though, because it makes the company's products appear more expensive in foreign markets. A weakening yen allows the company to compete on price more easily in competitive foreign markets like North America. North America is a very important market for Toyota. This market is the number one consumer of Toyota vehicles, and a network of 11 major subsidiaries and 14 manufacturing plants makes this region the second largest producer of Toyota vehicles. This network helped to provide Toyota with operating income equal to 138.9 billion yen. This cash inflow makes Toyota long in North America. In Europe, Toyota operates in 6 main markets: Germany, France, the United Kingdom, Italy, Spain, and Russia. Like in North America, Toyota practices localized production through 7 major subsidiaries and a series of manufacturing plants. In Europe, 70% of the units sold are produced locally. In 2018, this system produced operating incomes equal to 75 billion yen. This makes Toyota long in Europe. Toyota's major markets in Asia are Thailand, India, Indonesia, Malaysia, Taiwan, and China. Toyota operates manufacturing facilities in each of these major markets. And in 2018, the company produced a total of 1,601,473 units through its Asian subsidiaries. These operations provided Toyota with operating income equal to 433.2 billion yen, making the company position long in Asia. The other category consists of the rest of the world: South America, Africa, the Middle East, and Oceania. Toyota does not offer much detail on this region's operations, but it does provide the major national markets in each area: Brazil, South Africa, Saudi Arabia, and Australia. In total, this other category produced 112.7 billion yen in operating income in 2018. This makes Toyota long in this mega region. Turning to the correlations, we can see that Toyota being long in every major region, we would expect the company's stock returns to have a positive correlation with each of the regional currencies indices that we developed. That is to say, we would expect that the appreciation of these foreign currencies would coincide with an increase in the value of Toyota's stock. This relationship is due to the effect that foreign exchange rate has on income when it is transferred from the foreign currencies to Japan's home currency, the yen. Because Toyota's functional currencies are appreciating relative to the yen, when the company translates these strong currencies back to the yen, Toyota makes a gain through the exchange process. Our correlations support Toyota's long position in each region. As you can see in the correlation table shown here, Toyota's stock returns have a very strong correlation with the currency index of each region. So as the currencies appreciate, so does Toyota's stock. Looking at the risk and hedging strategy, we utilized as a baseline measure of risk, we looked at Toyota's beta using the S&P 500 as a benchmark measure of risk in the economy. Using this data, we calculated Toyota's relative volatility. We found that Toyota is 1.4643 times more volatile than the S&P 500. While there are many factors that contribute to Toyota's volatility and risk, foreign currency exchange exposure does play a role. Based on Toyota's own value at risk analysis, the company's foreign exchange position represents a potential loss in pre-tax earnings of 206.9 to 214.6 billion yen. To protect from this foreign exchange exposure, Toyota uses three main strategies. First, Toyota uses a combination of forward currency exchange contracts, currency options, and interest rate currency swaps. The nominal value of this program amounts to 22,639,262,000,000 yen. In terms of fair value, Toyota's position consists of 257 trillion derivative assets and 197 trillion derivative liabilities. Therefore, the net fair value of their derivative program is equal to about 60.5 trillion yen. Second strategy Toyota utilizes to hedge is to produce its vehicles locally in each region. The company claims that this program reduces foreign exchange exposure by more often denominating revenues and expenses in the same functional currency. This program also protects against trade restrictions and tariffs, and also strengthens Toyota's just-in-time inventory system by increasing the localization of their supply chain. Finally, Toyota utilizes joint ventures to help mitigate risk. This strategy does not directly protect against foreign exchange risk in the same way that derivatives do, but it does help to spread out the risk that can be associated with making large investments in new foreign markets.
Now moving on to Ford. Ford has become one of the world's largest automotive manufacturers, mostly known for its full-size truck lines since its founding over 100 years ago. The company is divided into three main business segments: the automotive, the mobility, and the credit segment. The automotive segment focuses mainly on the manufacturing and sale of vehicles and accounts for over 90% of revenues. The mobility segment's main duty is to serve as an R&D role as the company attempts to develop automated vehicles. And lastly, the Ford credit segment serves as the financial wing of the company, assisting Ford customers who are purchasing their vehicles. In the fiscal year 2018, Ford operated globally with 199,000 employees across 253 subsidiaries. Ford is exposed to a fair amount of currency exchange rate risk due to their international network. Moving on to their methods. Ford's financials are not provided by country. However, they offer earnings before interest tax data broken up by the major regions: North America, South America, Europe, Asia, and the Middle East and Africa. We developed indices for all of the regions made up of the currencies from the major markets in each region except for the Middle East and Africa region, as they did not offer any details in the 10K as to which markets they operate in, and due to their small relative effect on the company's finances. To create our indices, we analyzed data about number of units sold and relative GDP size to develop weights for each currency year's worth of weekly currency returns. Moving on to short and long positions. To create these positions, we relied on Ford's regional breakdown of EBIT. In North America, they account for 65% of the automotive revenues and 86% of earnings before taxes for Ford Credit. This is where Ford produces the most vehicles through a network of 32 plants and are operated by 33 major subsidiaries, most of them being in the U.S. This is the only region with a positive cash flow, with EBIT equaling $7,607 million, along with Ford Credit providing a positive cash flow of $2,263.5 million, giving North America a net long position of $9,870.5 million. Moving on to South America. Ford operates one major subsidiary in each of their two main markets, which consist of Argentina and Brazil. South America generated a cash flow for Ford with EBIT of negative $678 million despite producing $5,300 million in revenue in 2018. This constitutes a short position in South America. In Europe, Europe is Ford's second largest market behind North America and operates 15 major subsidiaries. The automotive segment operated at a loss with EBIT equaling negative $398 million, while the credit segment operated at a gain with earnings before taxes equaling to $363.5 million, producing a net short position of negative $34.5 million. In the Asia-Pacific region, Ford operates in 8 major markets in these regions that are maintained by 4 plants and 5 major subsidiaries. Ford produced $12,400 million in revenues in this region, but expenses outweighed sales, bringing their EBIT equal to negative $1,102 million, which supports a short position.
Looking at the correlations, because Ford is short in every region except North America, we would assume that the company's stock returns would only have a positive correlation with the returns of our North American index, and would then have negative correlations with every other regional index. A negative correlation implies that when the foreign currency depreciates, Ford's stock returns increase. When Ford has a cash outflow to a region, it wants to see the currency depreciate because this means that Ford's American dollars go further in covering its expenses in foreign markets. We saw this negative correlation in South America and Europe, but there was a counterintuitive positive correlation with Ford stocks and our Asian currency index. One potential explanation for this deals with the relationship between foreign exchange rates and consumer buying power. Like we mentioned earlier, Toyota benefits when the yen depreciates because it makes Toyota vehicles appear less expensive in American markets. Similarly, Ford benefits when the yen is appreciating because it means that the companies like Honda and Toyota are not as price competitive in the US. We ran a correlation between the yen and our Asian index and found a positive correlation. This means that as the yen increases in value, so does our Asian index. This could explain the positive correlation between Ford and the Asian currency index. Despite the fact that Ford is long in Asia, its stock value increases when the Asian currencies appreciate because strong Asian currencies make Ford more competitive against foreign car companies in the US market. Appreciating Asian currencies means that Honda and Toyota can't as easily compete on price against Ford. This helps Ford's sales, which in turn increases the company's stock returns. Now looking at the risk and hedging strategy. We utilized beta analysis to compare Ford to the S&P 500. We found that Ford is 1.8128 times more volatile than the S&P. This also means that Ford is about 23% more volatile than Toyota, who had a relative volatility of 1.4643. Ford attributes a great deal of this risk to fluctuations in interest rates, currency exchange rates, and commodity prices. In 2018 alone, currency exchange rate risk cost the company $750 million in losses. To protect against these risk factors, Ford has developed a strong hedging program. The nominal value of Ford's entire hedging program is $142.75 billion. Just below $42 billion of this is meant to hedge against currency exchange rate risk. Approximately $100 billion is meant to hedge against interest rates, and $638 million against commodity prices. The net fair value of this entire program is equal to $308 million. Like Toyota, Ford also protects against foreign currency exchange risk by entering into joint ventures in foreign markets. 18% of Ford's facilities abroad are joint ventures. In analyzing these companies, it is clear that Toyota enjoys a much stronger position in the automotive market than Ford. Toyota has positive cash flows from every region in which it operates. Ford, on the other hand, is only profitable in North America. Toyota is expanding its product lines and building market share in emerging markets by offering market-tailored products and new compact models. Ford, on the other hand, is pulling out of markets while also cutting product lines, such as all sedans except the Mustang model in the United States and North America. The one place Ford does excel, though, is in its hedging program. Toyota stock returns and the currency index returns correlate strongly with coefficients in the range of 0.6 to 0.7. This implies very high exposure. Ford, on the other hand, has correlations that were at or below 0.1. This makes it look like Ford has a much stronger portfolio of derivatives. But Toyota and Ford held the same proportion of derivative assets and liabilities, 57% assets, 43% liabilities. One explanation for this could be that Toyota's policy of localized foreign production does not protect the company from foreign currency exchange risk as much as they claim. Over 80% of Toyota suppliers are still based in Japan. When operating a regionally localized global production and distribution network, having such a high concentration of suppliers in one country has the potential to increase foreign exchange exposure. Whether or not you value Ford's hedging policy or Toyota's strong cash flows, it is clear that currency exchange risk plays a major role in the automotive industry and is an important aspect of analyzing any company. A successful corporate strategy must take into the account of corporate exchange risk and hedge against it.